Hi everyone, welcome back. I hope you have been able to run and grab yourselves a glass of water. We are really excited for this session. We've got Francois on the line now, and I'll get him to turn on his video and microphone if he can, please, Francois. While we wait for Francois to turn on his video, I would like to introduce him. Some of you will have had Francois's feedback already on your fundraising documents. As I said this morning, you'll realize he's a very straight to the point Frenchman. He is in fact the most dashing member of the newfound team. He's a leading advisor on fundraising, investing and growing technologies. He's worked across the US, Europe and the UK. He's currently the founder and CEO of Tomorrow, which is South London's largest co-working space. And he's also the founder and CEO of Fundraising Bootcamp, which is a fantastic 2-week program that works with startups who are ready to go to VCs and ready to get that investment to really supercharge their pitches and make sure that when they go out to markets and when they go out to VCs and investors, that they're getting the right advice, they're approaching the right people, and that their decks are in perfect shape. So Francois is a fantastic addition to this program. He'll be, here he is now. Francois will be the person that will guide you through really the ups and downs of fundraising in the UK and help explain to you what it is that people aren't telling you and where it is that you need to go to find the money that you need to make your company a success. So Francois, if you can turn on, here he is, if you can turn on your video and microphone, and I will hand over to you.
Perfect, I am. Good morning, everyone. I am going to try and share my screen, which I think will be a lot easier instead of seeing my ugly face. Let me just do this here. Preparation, right? Preparation. Right. Can everybody see what I see? Since I'm hearing nobody, I'm going to take that as a yes. We're going to get started. Before we start, quick heads up, there's a chat function and raise your hand function. Use those. Marcella with me, my colleague, and she'll be monitoring the chat and the questions so that we can do a Q&A session at the back if you have particular questions or things that you'd like me to cover. Good. So let's get started. Can you all see my screen? I hope. If you can, let's get going. Raising money is an art form. The UK is one of the most difficult countries to raise money in, but also the most plentiful, and therefore it's something worth mastering. Whatever you're going to learn, you're going to be able to use that in any country, US included, and we help people do that. Before we start, I'm the French guy. I've been in technology all my life. I'm in my early 50s, and I've been in technology for 30 years. I've built 8 technology companies. I switched sides and became the investor and the company builder with a company called Speed Ventures. We built about 28 companies. We had 4 IPOs on the Nordic stock exchanges. And I've been turning around a VC-backed company that was supposed to be a great success, and it actually was a dog, and it died. I've had a bankruptcy. I've had a startup to NASDAQ IPO. I think I've got pretty much every good, bad, and ugly side of building a tech business. I run a company called Tomorrow, which is South London's largest tech workspace. It's got the usual trappings of beautiful offices, tons of space, and we help a community of small to medium-sized companies up to about 40 people with the 4 pillars of growing a business. It sounds obvious, it's not. I'm doing this with an amazing army of great people who are the finest and most famous early-stage investors. You might want to pick some of them or recognize some of them. Some of the serial entrepreneurs who've done extremely well here in Europe. For those of you who don't know King.com, I'm sure you have it on your mobile phone. It's the Candy Crush saga, etc. The second thing that we do is the fundraising bootcamp. We prepare companies and help them get their funding. We provide them with all the tools, the professional process and tools that professionals use to raise money, and then we give you access to our database of investors. Today we're going to talk about venture capital and the stuff that people don't tell you. The first part of it, which I think is critical if you're thinking or considering coming here into Europe, is that there is tons of capital. And that's something that the press has not really expressed clearly enough, most likely because it doesn't sell papers, it is good news. So last year, 2019, has seen a massive boom just before COVID of fresh funds pouring into the European ecosystem, which is fantastic news because it means funds have to spend that money. I'm sure you know a fund is a 10-year, has got a 10-year tenure, and the first 5 are the investment years where they have to deploy their capital, otherwise they don't get their management fee. They only get a management fee on money that they spend and then manage. Across the board, from Scandinavia all the way to even Eastern Europe, which is always the laggard in Europe, pretty much every government and every venture capital fund has replenished or doubled the size. So huge growth, tons of capital. On the left-hand side, you can see the volume overall, roughly $35 billion were spent, invested. On the right-hand side is the deal volume, the number of deals that were closed, and that's roughly 3,500 deals. So 35 bill, 3,500 deals. You can see that the overall trend is to go for not early stage, but for companies that have found their market, have found a few customers, they know how to get them, and then they're in their scale or expansion stage where they need capital to do the same, but at a much higher speed or at a much higher rate, and that's where much larger checks are written. Something to notice that you're not going to find on the internet again, typically, is that it's not always those who you hear about the most who actually do the largest number of deals. In particular, in early stage, if you look on the left-hand side, you're going to see that at seed stage, I'm pretty sure some of you have never heard of High Ventures or even Venture Kick. And therefore, you have to define your list of target investors based on your criteria, your company stage, your industry, your geography, and what the investors need to have or not have in their portfolio to be sure that it's the perfect investor. And you'll be surprised that in the early stages, you have a plethora of very early stage new fund and new investment and new family offices that are in the market that you've never heard of because they don't spend money on PR and typically don't announce the deals that they do. On the right-hand side, again, you can see that the most active investors in the early year, not super seed, but seed round, are not necessarily those that you hear about in the press. So do your research and profile your investors. What you hear about is the latest you double their size is because most of the traditional allocations of fund that were not touching VC are now actually deploying capital. And we're seeing a huge move from typically very traditional and cautious investment sources of capital, moving them, like the endowments, the foundations, and typically government pension funds, which yesterday would spend between 0.5% and 1% of their allocations. They roughly tripled that. Regarding geographies, Europe is not, all European countries are not equal. The UK is taking the lion's share of it. That's just a quick display of how much more capital you'll find in the UK, how many more funds, roughly is the rest of Europe combined. And also in terms of deals, the volume of deals has shot up. More and more funds means more and more competition, and competition leads to more funds having to look for alternative deals when they lose the ones against the biggest names, VC funds. So all in all, a very healthy ecosystem, fresh with capital. You have roughly 4 years to 5 years with COVID. I'll give that an extension, but I would say you have 5 years of amazing volumes of capital waiting for you to come in and present well. Finally, that's very in Europe. You're going to see a new class of happen, and these are European investors that have built, failed, rebuilt a business and did very well, and are now deploying their capital, just like a VC fund. Some have got larger personal funds than a traditional venture capital fund, and they're very active in managing, helping, advising, introducing the companies that they put money in. A brand new company, again, based on your industry and your stage and what type of investor you need, you now need to look at this new class of entrepreneurs going back in, because they provide, incredibly intelligent, connected, knowledgeable capital. So if you can, amazing source of funding. Now, the bad news is, as always, when you have a lot of capital, so there's a lot of companies chasing it. So this is I'm sure you're familiar with that, the investor landscape, somebody trying to do maps to show how many investors and try to put them into buckets. And that looks really complicated. But if you go and switch, you're going to see that the investor's job of the entire technology and digital landscape, this is what it looks like. Every single dot that you see is actually a company with staff, funding rounds, term sheets, problems, and growth opportunities. Finding that is truly the needle in the haystack. They go to conferences. This is one of the largest tech conferences in Northern Europe called Slush, and you're going to see this kind of stadia filled with people, all of them trying to pitch you. Impossible to filter. You go to smaller events, you get mobbed by people that are completely unqualified. I can hear that my audio is breaking up quite a bit, so I'm sorry about that. I'm not too sure what to do. I should restart my route. Should I restart the entire thing? My router. Oh, okay. Shall we take a break and I restart, or shall I continue? All right. Just switch to something else. It seems that connectivity is not good enough. I'm going to jump back in. Right, I think I'm connected to another network. Hopefully it's going to be more stable. I'm going to need some of you to text me and tell me if you can see my screen and whether you can hear me okay. Okay, so sorry about that. It seems that, good old live sessions always have a bug. So I'm going to restart. I was explaining investors go into meeting rooms and conferences and they get mobbed. It's extremely difficult to find the needle in the haystack. And the net of that is that if you come to Europe to try and fundraise, you're going to have to realize you are not that special. So you might have received advice saying, oh, you should be the Uber for this and the Airbnb of that. And I strongly, strongly recommend that you do not do that, for the simple reason that if you are just a copycat of something else, you're not going to be of any interest. You typically need to have something that's called an outlier, which is what the investors want to see. You want something that is different, special, and slightly on the crazy end of the investment spectrum. As an example, why you have to be different is that in London alone, not the UK, not Europe, London alone, last year saw the birth of almost 250,000 new startups. Love to see how many of those, I'm sure they'll be listed. Love to see how many of those are still alive today, especially with COVID in the middle. But just to show you the sheer size of startups being born and fighting for the same amount of capital. So if you come here, you're going to have to set something up that sets you apart from the usual run-of-the-mill copycat startups. There's plentiful. I'm going to take the view, it might be wrong, that for some of you, or most of you, it's going to be your first time.
So it looks a bit like this mixture of super exciting time and not having a clue what's going to happen. It's normal. You get about 85% of startups are normally run by people whose first time it is. It means two things. The first one is whatever you think is going to happen is highly unlikely to happen, but you haven't planned for it. So seek advice and try and build a plan that is not the beautiful linear growth that you see in an Excel spreadsheet with an algo. Just make sure that you have and you build contingency, extend your runway, have time to make mistakes and start again. The second thing, which the press and all that industry does not tell you, is that you're not going to get a second shot. Again, 250,000 companies, investors are not going to be able to see most of those. They're only going to have to pick a few hundreds to a few thousands each year. And therefore, you're going to have your shot. There is no coffee chat. There is no chat and come back. Every time you're going to meet an investor, you're going to have to be ready, have your documents and your data and your financial storyline ready so that you have a impressive first contact. You're not going to get a second chance. And therefore, most of you don't make it because you go out way too soon, way too unprepared, not having the background information, the financial storyline, the basic data that investors demand and want to see and want you being able to deliver without having a slide deck and a projector. To them, and this is a very difficult task. This is what it looks like. 90% of startups fail in the first year and a half. This is roughly what they look at in their portfolio, as well as new companies that come and pitch them. So you want to be sure that you position yourself as those 5 companies left in the hundreds that they have met. It sounds obvious, but most people think of their company and their needs, don't see themselves through the eye of the investor, and it's my strong recommendation that you turn the tables and say, what is it that they see in me instead of what you want to be seen? Plenty of mistakes. We all have done them. I'm not teaching or preaching. I've been the first one making them all. The first one on the top left is the most common. A lot of people think that they deserve somehow to be funded or have venture capital put money, when really their business can be an amazingly profitable, relatively small, amazing lifestyle business that will spit out cash. And they should be proud of this and go for that, but not believe that it's a venture capital. Venture capital will demand outstanding returns, 10 to 100x, will be extremely demanding, and will be the most expensive cost of capital. So most people make the mistakes of believing or convincing themselves that they are VC-able when they're not. And the second one is at the bottom right, which is way too many entrepreneurs don't chase. So you get a blank, you don't get an answer, you give up. You don't have a process or a campaign that follows up every other lead. And yet, investors have plenty of reasons, and I'll show you a few, why they shouldn't engage too quickly, why they want to be given more time to meet you again, to understand you better, and to see whether what you've said 2 months ago you've actually executed and delivered, or whether you're just full of dreams but incapable of doing stuff. So you need to plan for plenty of time, and you need to be sure that you are actually VC property. The investment process, again, you're not going to find this easily because it's the dark side of fundraising, is that to keep things simple, if you're an early stage or a seed stage company, you're going to have around 60 meetings, 60. To get there, you're going to need to have at least 80 to 100 fully qualified investors. Fully qualified means having people who invest in your industry, people who have no direct competition in their portfolio in that industry, people who invest at your stage, and people who actually like you. Because at the end of the day, they're going to want to like you, and you're certainly going to want to like them. So that's the kind of metrics that you have to keep in mind. It's 60 meetings, 60 investors, about 40 to 60 meetings. I think this is a rather optimistic slide, and it takes at least 3 months. What I've seen in practice is closer to 6 than 3. The following round is going to be slightly easier, not by much. It's still going to be 30 investors, about 30 meetings, and about 10 weeks to 12 weeks to complete. So planning and having all your documents ready is critical. That's it's a long process. I'm not going to bore you with this. Something that's interesting is everybody thinks that they can get a database, spam it, and then it'll be fine. People will self-select. It's exactly what you don't want to do. If you look on the left-hand side, the ratio of investors contacted versus the number of meetings, i.e. the number of successful hooks that you've managed to do, how many people get your initial pitch and why that's an interesting person to meet and call you in, is stays within that under 100 investors contacted. So it's definitely about quality, not quantity. Same thing for how much you want to raise. It's not because you want to raise a larger round that you need to have more investors, number one, and number two, that you're going to get more investors. So big chunk of that is going to remain within the under 100 investors contacted, pretty much irrespective whether you're raising 1 million or 4 million. Everybody tells you to spend so much time, and that people really dig into your pitch deck. It's not true. What you're going to see is the average. This is done by DocSend. DocSend is this system you might know where you upload your pitch deck and then it gets distributed to prospects, and then when they open them, everything gets tracked, the time, which pages they spend on. So you're going to have a very, very strong pitch with very few messages, because that's the amount of time that you're going to have left. Everybody says that they want to see a vision, a mission, an amazing founder. Look at the amount of time they spend on the actual decks. No great change from what you knew before. The first thing that they're going to want to look at is, what's the financials? They're investing in a business to return the capital that they have borrowed. They want to feel very comfortable that with simple numbers you can achieve greatness, and therefore their 20% share is going to return at least 10 times the capital they've put in. And to achieve that, what you need a stellar team. I'll cover that a bit later, but the team is what you want to sell. Way more than the idea, way more than the problem and the solution, which, as you can see, are right at the bottom of the priority list. The good news being that you have now around, all the major and failure companies have put up their deck. So you can see how it's structured. You can see the short decks, the long deck, how people actually structured their deck. So there is no excuse. When I see badly presented decks that don't have a storyline that you can follow, you don't have a story that you can read easily just reading the titles, it means that you haven't spent 10 minutes looking at some of the examples of the other companies. There's no shame in copying. Just use something that is close to you and your industry and that has got a storyline and it's easy to follow, and just use that. I'm not going to bore you too much. VCs have got a terrible reputation. Everybody makes them, acts like they're demons and horrors, when really that's what they look like. Don't know how much of them you know. The left-hand side in black and white is typically American. Great names. To the right-hand side, you're going to see people from Europe over here. You have a smattering of women, but it's typically white, middle-aged, slightly paunchy, super smart, the good kids at school. If you're pitching on a demo day or investor day here in Europe, this is most likely what you're going to see as the audience. Very, very little change. You have some of the greatest funds like Balderton. You have one of the new entrepreneurs turned investor, the guy with the white shirt right at the front, who's in the CTO and co-founder at Eventbrite. Anyway, you get the idea. So get ready for that. We are not the same, and be reminded of this all the time. You are there to build something that you feel passionate and very strongly about. They are there to find a company that can return 10 times the invested money. And it's just not, a nice profitable business that doesn't suck in cash and turns profitable quickly is all nice and good, but that's not for venture capital. Therefore, what they look for as a signal is growth. What they want to see is market and traction. So when you get asked all the time, hey, what's your traction? It's not about the number itself. It's mostly about the traction rate. If you go from 1 to 2 to 3 to 4, this is very low traction. You want to be able to show some numbers that show a 10x multiple. It doesn't matter what the start is. It's just the trajectory and the multiplier that will get them excited. I'm sure you know about those. What investors want to see is an amazing execution team. You've seen why, you've seen where they spend their time, And also they want to be sure that if you're raising a significant amount of capital, this is a company that has found customers and you know that the customers want to use the product. They use it extensively or repeatedly, and some of them are happy to pay for the extra features or the premium version or the pro version. Without this, you are not ready for a Series A or a large round of, so you have to go back to the table. What nobody tells you, because everybody has an angle, everybody wants to be the friend of the venture capitalist, but I don't, is that they are actually very strange creatures. Most venture capitalists will see an investment as a slow date. They want to first, and most importantly, really like you, because they're going to be spending 10 years of hell with you. You're going to run out of cash, possibly. You're going to need to be bailed out. You're going to have your best salesperson leave you. You're going to have your customers with 20% of the total revenue decide to switch out. You're going to live through hell, and therefore they want to be sure that you are the perfect match. And that doesn't happen over 2 meetings and 2 coffees and a pitch deck. It happens over a long time. So expect them to ask a lot about you, and vice versa. You should be demanding to spend time with them before you take their capital, for the simple reason that you don't want to marry an arsehole. So go out. My recommendation is always to go out, go on walks, go to restaurants, see how they treat others, the staff, see how they treat other people, see if they walk ahead of you or behind you or with you, etc., etc. You get the idea. Make sure that you find a partner, because it really is a partnership. They're slow daters because they want to see data, they want to see progress, remember the trajectory, they want to see how fast you grow and whether you execute what you say you do or whether you're just dreaming. And after that, they're very self-centered. They're the super smart guys. So, cheap flattery doesn't work, but they want to be served, intelligent information. They want to analyze it, give it back to you, or give their analysis to you, which is to most of them a way of contributing as a partner to the success of the company. So just play along with it. To be able to do that, you'll need to learn a few things. First one is going to be, who does what are the jobs, what are the titles, what are the seniority in a VC fund. These are the top titles that you need to know. Remember, the entrepreneur in residence can be your worst enemy, because it's somebody who is from the industry or an industry or wants to get into your industry. And if negotiations don't go well, it's normally the person that can either take over your business or build something directly competitive. So be very cautious with information you share with entrepreneurs in residence typically. Some of the lingo that you've heard, that these are really the basic that you're going to have to learn. We have a whole dictionary of them that you'll have to learn, but I'm just showing you one page so that you can have that. You will be able to download the PDF with all of those, so you don't have to take notes now. But at the end of the day, you're going to have some of the basics so you can have intelligent conversations about why you are making an amazing investment, not just a great product and a great team, but why you're an amazing investment to make. The types of plenty of rejections, plenty. Some people get lost in them. These are roughly your 6 categories that you need to think of before you go out to say, am I going to be able to answer some of those claims, which would lead to end of game. You have 6 major categories. A lot of people see a $20 million or $50 million market as something that is worth going for. Venture capitalists will not. Tons of market issues. Too early, too late, too small. There's plenty of reasons why timing is everything, and small markets don't make it. Anyway, I'll leave you with that because we could spend an hour on this. To summarize, and especially here in Europe, there's an easier list for you to remember, and that's your instant disqualifiers. If you want to build a deep tech company, and my God, if you don't have AI, do not mention AI. It will be an instant disqualifier. Make sure that you have a technical founder or a founders team. Hiring great CTOs is extremely difficult because every tech company with much bigger funds than you is paying way more and putting them on projects which are super exciting. So building a deep tech with no deep tech will get you immediately disqualified. Go back to the drawing board. Claiming that you don't have any competition is simply stupid. Competition is not somebody that has the same product or does the same thing. Competition is the share of the wallet being spent that should be spent with you, but today is going to somebody else's. So rebuild your competitive slide include all of the offline, the old dinosaurs, because as long as customers today pay them in cash, they're a direct competitor. The valuation is, kind of obvious. Either you're going in way too high, too early, or way too low. Plenty of people, plenty of multiples. We can help you with that. Or you have a very long email which scares them, saying, I'm going to be drowned. There is no clarity. You're not crystallizing the value proposition or the investment proposition. So try and keep things short. Then you have the nightmare ones, the unspoken ones. And the unspoken ones are typically stuff that you have nothing to do with. So just like any large company, you have politics at play, and most investors will need to have a 2/3 or 100% vote before the investment gets done. And that involves a lot of people who either hate each other or want to block each other or have a competing deal that they want to pass, etc. So loads of no's you'll never hear of are internal politics. It can be that they are talking to something that could be competitive in the portfolio, but they're applying more importance, rating it more highly, and therefore you're being downgraded. Nothing wrong by you, but you're the plan B. You have a lot of hype. Either you are right in the hype, or you are out of the hype cycle, and investors are very conscious of the press and the media. And then you have other investors, what they've done. A lot of investors see and try to copy the portfolio of other VC funds. If you fall outside of that, you're a good investment, they like you, but you're no longer the hot thing that they want to chase. Where still is how sometimes you're being used, and again, information nobody wants to share, but it's something critical that you have to detect very early. One is free training. Do not think that investors know about the brand new sectors like blockchain, or any chains, in fact, like digital currencies and the change to ecosystems. They read and they meet amazing people like you, founders and people who execute and build businesses with all the knowledge, all the industry data. So they call them in and have a chat. You think it's a chat about your company, and actually it's nothing but a chat about you providing an hour of free, intelligent training, disclosing years of what you've built and years of knowledge that you have for no other reason but to educate them. And you want to get out of that, obviously. Your time is the most precious, rare resource that you have. Same thing for other investments. You have to ask full disclosures ahead, saying, are you doing that? Do you have another investment that you're reviewing which is within this category, so that you know that you're not just being fished for data to validate somebody else's investment. Funds are just like you, raising funds before they spend them. They have to go and raise. And one of the key things to raise a venture capital fund is to show that you have access to prestigious and or proprietary unique deal flow. So they're going to go fishing for a while, trying to find interesting companies with a bit of hype in a hot sector with a great looking team. They have zero intention of investing simply because they haven't raised the funds yet. But to attract you, they're going to say they have the funds, come and meet me, give me your deck, show me what you do, so that they can put that together into a virtual portfolio of companies and go and raise money on the back of that. So you always want to be sure that the funds have been cleared, not pending, subject to. Otherwise, you've just wasted your time. I can't take you through all of them, but something that you must be aware of here. Two things. One, you have plenty of dirty tricks in term sheets. On the left-hand side, you have the most common that you're going to find, which basically allow anti-dilutive provisions, which means that if you have a negative round or a really bad year, you need to raise money again to save the company, but the valuation is lower, you're pretty much going to have the full amount invested by the previous investor will have to be given in shares again, and not pro rata of the dilution, but 100% of what they've invested in. Extremely, extremely expensive. If that happens a couple of times, and most companies go through dark patches a couple of times, you end up with giving away most of the investment again twice out of your shares. I'm not going to go through all of them there because it will be way too long. You're very welcome to ask me questions. If you have one in particular, please ask a question in the chat. We'll pick it up. On the right-hand side, the summary of it all is that you are going to be doing in your life, 1 to 5 companies typically. You're going to raise 3 rounds, maybe 4. These rounds are very easy, they're not complicated. So you'll be raising 3 to 4 rounds with professional investors. They do a deal a month, sometimes way more than that, and they are extremely, extremely well versed in term sheets. You are not. So the only thing that you can do is to not try and fight or make things complicated, because you will lose every single time. So try and keep things super simple. Is the critical foundation of negotiation for you. Let's go to the next one. Fundraising is made way too complicated and way too long. There's only a few things that you have to do well. If I had to choose, this would be this slide. Do a lot of work before you go out. Going out fundraising is pretty much like selling fresh fruit. You have a few weeks after that, you'll start rotting. Everybody talks to everyone. So you want to be able to have all your documents lined up and talk to all the investors at the same time, so that you actually have a competitive and a level playing field where nobody can block you from talking to other investors and stretch out the duration during which you run out of cash, which is a classic tool that they use. You have to be able to have open conversations, be yourself, be natural. Therefore, you have to learn the lingo. You have to learn how they think. You have to ask them questions about their own fund. Anyway, you get the idea. Something that not enough people do, or at least I haven't seen it, you seem to speak to whoever talks to you. So you're going to get a call or you're going to get an email from typically a bottom feeder, a new fund, not prestigious, not very rich, and they're desperate to get into deals, and therefore they're the ones who are going to give you the call. And you're going to take them because an investor is an investor. And that's the biggest mistake that you can make. Since everybody speaks, to summarize, an analyst, the person who is the first point of contact, will be leaving and changing jobs every 2 years. They all want to become principals, the principals want to be investment managers, the managers want to be directors, etc. You're going up. And every 2 years they change. What do they have? The only asset they bring to the incoming company is their stack of deals. And that's you. And that's your super secret file. And therefore, talking to a fund that thinking that it's going to be secret never happens. So why pyramid of priority? It's simple, is that you want to start with the very best investors because everybody wants to co-invest with them. It almost doesn't matter what you're selling. What matters is that you are of interest to a fund that is higher up the food chain from the smaller, lower, bottom investors. So always start at the top, not at the bottom. You cannot go up the pyramid, you can only go down. So that's what normally a finished list with your 100 investors looks like. It's not difficult to do, it's just that you have to prepare the time and give each layer about 2 weeks. You explain why they are the first, your favorite, and then you move on with zero emotions if you're not hearing anything. Your chances of the top funds is, that they say no, 99.9 times, so therefore you do it so that you never regret not having spoken to the best. And how do you do that? You assess your funds. And to assess your funds, there are a few things that you have to check. Otherwise, you're literally throwing your company away. The first one is the term. A fund is a 10-year beast. They have raised money. They have 10 years to invest it. That's roughly 5 years out of the 10 where they have to invest the funds, and then 5 years where they grow the companies and sell them. So VC funds have reserves so that they can continue investing in the companies that are tracking the best, and therefore they have cash. And sometimes some of the companies that they had reserves for fell or go bust or sell, therefore those reserves haven't been used. So they have capital to spend, and they have to spend the capital for them to get all their fees. Therefore, you're going to be invited by a fund that actually has got capital that was not for you, but it was for somebody else. And they have another year, maybe 2 years left in their fund before they have to liquidate all of their shares to take their commissions, their fees. The last and the worst place you want to be in is to be in a fund and just get it going, just get investment in year 8 or year 9, knowing that in 12 months they're going to sell for whatever They don't care the share price that you have. They're going to sell it and completely dump your stock because they've made their money with a Spotify or another great investment that has returned all of their funds. You will be literally, the baby thrown out with the bathwater. So one is term. Make sure that you're there in their investment period, not in their end of life. Number two is the size. I've explained the reserves. They need to have enough capital to follow you. If things go well, last thing you want to do, and the worst signal is when they invest in you in the first round or the second round, and then they, simply because they've run out of cash, they can't continue investing in you, sending a massively negative signal that most other investors will pick up and say, well, they're not investing. Doesn't matter that they claim they're out of cash. There must be something that they know that we don't. Otherwise, they would find the capital. So the size of the fund, how many investments they have, and how many investment with cash reserves they have, so that if you achieve your forecast, they can continue investing in you, is critical. The rest is kind of obvious, right? Don't go into structures that are tax havens in the Cayman Islands, will be right in the middle of the radar for all taxmen and governments and all that. Try and find a normal, safe structure that is, standard, not exotic. Nobody likes exotic in governments, in pension funds, or the investment circles. And then the partnership. Is it just one guy making all the decisions? In which case, are you in direct contact? Or are you just talking to a subordinate who has no power? Critical that you get to the top of the decision tree, etc. How you get access to all this information is remarkably simple, but nobody does it, and I don't understand why. When you meet an investor for the first time, and you know that the first session is going to be strictly whether you guys want to be together for the next 10 years. There will literally be nothing else that matters. They're just going to want to see whether they like you enough to spend 10 years of hell, and you should be doing exactly the same. Is it a person that you trust? Is it a person that will listen to you? Is it a person that will come up with solutions, not just problems, etc., etc.? We normally ask simple questions, and the way for you to not be impressed or not knowing how to engage is to imagine yourself having inherited some money and you want to invest it in a VC fund. Ask the questions that you would if you were the investor in them. What you're going to see, which is amazing, that most VCs love to sell themselves as the best fund, the ones with the tricks, the one with the experience, the one. So ask them how they pitch an LP. How much have they invested? How much is left? What kind of board composition they have, what kind of entrepreneurs they have, or is it just financial people in the team? What's the average investment they've made? What are the last 3 deals that they've done? Do they have a favorite sector they want to invest in? All of those questions that you would ask if you were investing in them. And then that's the way for them to pitch, and they love pitching how great they are. It establishes a much healthier conversation instead of you being the one asking for money and them asking all the tough questions. You get the idea. I've told you, special, yet investors only seek outliers. They don't seek a copy of Airbnb because Airbnb is done. They don't want a Uber for grannies because, Uber will take that over. So some corporate VCs want to invest for something that they will then buy, and that's one strategy. But most investors are going to look for something that is new, slightly crazy, sounds like a potentially bad idea, but if it works, it's well ahead of the market, and the market is massive. Remember how Airbnb started. Why? Because they are going to be looking for these weird, creative people who are not copying, but they are different. They're building something that the world is not. So the biggest asset that you can pitch, you have no real revenue, no real customer. You don't have a massive company with assets. You don't have a balance sheet. But one thing that you have and that you can get is an amazing team. A team of, a diverse team, a varied team. And it's something that through your culture you can attract. Many people from large, big corporations get fed up and eventually want to do something exciting and new, and they join a startup for the simple reason that they believe in your mission. We're all going to the moon. Come and jump and help us build, one part of the engine. And this is how you can get people against the Google, the Microsoft, And this is what investors invest in the most. If you look on the right-hand side, you're going to see three different types, very different types of investment funds. They all have the same homepage, though. They back exceptional entrepreneurs, people, amazing, weird, creative people who don't copy others, but make something new. And that, once you have that, a team, very, very difficult for them to think, oh, I can build this. Life's a pitch, so you're going to have to get used to it. I think I've already mentioned this. Your pitching is not about raising fund. Your pitching is first to build a connection. The investors demand it. You should demand it, even if you're desperate for capital because you're running out in 2 or 3 months. But you have to be yourself, have to establish this thing. Do I want to meet that person again? Do I want to hear more information? Do I believe that that person is going to help me when I need it? So your first and only job, and it's the only job of an executive summary, is to have a hook, a mental hook to the brain. And how do you get those hooks? It's typically by having a very, very clear single message, a storyline that is made of the titles of your pitch decks that tells a story that is normally going to trigger one of the three things in the reader's mind. The first one is going to say, that's impossible. That sounds too good to be true. It's impossible. The second question could be, how does it work? You know, the greatest inventions in technology always sound like magic. How does this actually work? The third one is to say, how can you say this when the rest of the market is going the other way? So 1, it's not possible, it sounds too good to be true. 2, how does it work? 3, why is it going in reverse to the market? And that's, remember, the definition of an outlier, the one sticking out, standing out. And that's a guaranteed, surefire way of getting your first meeting. So your pitch is not about cramming all the information into a 3-minute or 30-second pitch. It's about being yourself and having one of these 3 mental hooks to the brain so that you get your meeting. If you speak, try and speak slowly, obviously. And you don't have to be an actor. You don't have to certainly not use any script. Don't recite anything. And just explain less is more. Just have a comeback hook, something that people want to see. So it drives me nuts that after all of these and these thousands of free tutorials, you still see this. This was taken a few months ago at one of the judging panels that I had. Complete disdain for the audience, or PDF brochures that are simply illegible. Something else about the first call that you're going to get before the meeting. These are some of the questions that you should expect. Nothing there is a trap. Everything there is designed for you to structure a very short, concise answer. But this is what they're going to have to see before they meet you even. Your only job is to sell a meeting. Their job at this stage is to say, why should I have a meeting? And these are the usual filters that they're going to apply. So just get ready. You'll have a copy of that PDF. You can actually write them down and then have a clear answer, 30 seconds. I don't know, or I don't have it yet, or that's something I'm working on is a perfectly fine answer, by the way. But again, first meeting, when you explain, you have your 12-page deck as a support tool, not as a scripted speech. You have to be yourself. You have to be prepared. You have very simple, crystal clear proposition, or what you want to do, or why you're special, or why you're doing things differently. The goal of that first meeting is not to get an investor to want to invest. I know it sounds weird, but it's not. The only goal for your first investor meeting is to get a second meeting. Is to have somebody who says, that sounds, again, too good to be true, or I can't understand how it works the way that you're doing it. Sounds amazing, but it sounds weird. Really? Is it a hoax? Or number 3, why are you going against the grain, against the white sheep? I need to see you again. Let's go in depth into one of those 3 points. So, goal of your first meeting: don't sell shares, don't sell the company, don't talk about the investment. Make sure that you have a good interaction with the person and you have a mental hook to the brain, because you will get a second meeting. And it's the second meeting where you will then identify through their questions what they don't believe or what they want to scrutinize, and therefore what they're particularly interested in. And that's the hook that you want to then spend some time on and explain how it works, or why you think the opposite of the rest of the market, or why you're so radically different, or why you believe that everybody else is wrong, but that you're right. Because remember, investors seek outliers. They don't want copycats. Something else that I've seen missing in pretty much all of your slide decks, or those that I have actually reviewed, is a financial storyline. When you start a company, you normally have one big dream, one big vision, you have very little else, and you're trying to assemble the best team that you can build with people who believe in that vision. If you want to raise expansion capital or a Series A, you're going to have to start talking numbers, because investors are investing in the capability of returning 10x. So you have to know and learn by heart your basic numbers and show me very simply how much it costs you to get a customer, how much a customer spends, how much it spends in total, and how much margin you generate out of that. It's super simple. European investors are typically very focused on downside protection, unlike the US. So they're gonna want to understand how many units need to be sold until you don't come back for more funding. You know, that's your break-even point. It's critical for investors. They will then also question how many units need to be sold at the margin before you make $1 million profit, and before you're worth 100 million, which is roughly 8 million a year, depending on your industry. So these are the basic items that you need to be able to explain without any jargon, but explain as if you were talking to your neighbor, saying, this is this business, we're selling unit for that much, it costs me that much per customer to get them, it costs me that much to operate, and that we roughly clear that much per unit. When I do that amount of units, I break even. That amount of units, I'm worth 100 million. Deal dynamics is something we spend a lot of time on. You are always thinking that you're behind, and therefore you always try and catch up with investors, when in reality, nothing happens for a long, long time, and then everything gets squeezed in the last 10 to 20 days. So be prepared for that. You need to, as I said, go out with all of your documents ready, so that you don't have to have sleepless nights trying to build an Excel model. You need to go out with everything that you need to show and tell. And then after that, you wait and you just remind people. As soon as you have one typically interested person, that person or that fund is going to try and tie you and have an exclusivity period where you can't talk to anybody else. And that's the time when you go to everybody else very quickly before being locked out, and explain that you have interest from one investor. And suddenly, or typically, then everybody wants a piece. Nobody wants to lead, but everybody wants to be a co-investor, especially if it comes from a fund that is higher up the food chain, if you remember the pyramid I showed you. So always go from the top. As soon as one of the top guys says, oh, interested, I'll give you a term sheet in 10 days, then you run and you only get another 1 or 2 or 3 other co-investors on the basis that you have been attractive to a more prestigious fund, high above. So very little happens, if not, sometimes nothing at all, and then you get your first hook, and then you go back to those who are waiting, sitting on the fence, and then everybody comes in at the same time. So you got a month of hell where you close. That's the dynamic that you should. I'm not going to bore you with the teaser. This is a 1-page, 2-side document. It's just an example what you send if you have to send documents to get you to your first call, and then sell on the call. The first meeting, this is what you need to do. 8 categories: what you do, problem, solution, the rest, how you compare, and then the market size, how you make money, why it's you and the team. I hope it's useful. I'm being told to wrap up, so if you want to move into a Q&A, or if you have other questions, I can't hear you, Elizabeth. So Elizabeth, take over and tell me.
Thanks so much, Francois. We've had lots and lots of questions on the side, and I think Marcella is going to send those through to you so that you can answer them as we go along. I know lots of people have found the session quite challenging, and we know this is really the sort of where the rubber hits the road. So we don't want any of you to feel overwhelmed. This is really about setting a standard so that you all know what it is that you are aiming for when you come into the UK market. And Francois and his team are really the best in the business at making sure that when you're ready to start pitching, you'll be going in successfully and making those pitches, and also helping you to identify whether or not, as Francois says, you should be going in for the sort of the VC level, or whether actually you're much better going off for smaller funding rounds and not going in at that incredibly competitive level. So, Marcella,
yeah, I can add one thing to finish to also comfort people. One is every funding round is different, so make it yours, and what you need matters, not what the market wants to see. So focus on you and what you actually need. You need 18 months of runway, and then what you what you need to do is define when you need the money by.
Great, and I'll turn my video on. Francois, I don't know if you can try turning yours on now and see if we can keep your sound working. We'll keep our fingers crossed for the technology. So the first question we had was from Josephine, asking what the sort of pre-seed and seed categories were in terms of funding levels in the UK.
What do you mean in terms of volume or in terms of value? What do you mean?
Josephine can hopefully clarify that. I suspect she probably means in terms of sort of turnover and company value.
I was actually just thinking about, you know, sometimes we use different, you know, different values for different amounts. So in Australia, what would be a seed round? Would that be the same in the UK? So I looked at one of your slides that said seed would be less than 1.5 mil, whereas, or pre-seed. So what would you consider a Series A?
A Series A typically will be 3 million and up. Why? Because then if you get for a large amount like this, it's because you have defined the simple storyline that I explained, the financial storyline. A customer cost me $50 to acquire. They spend $10 a month on my subscription, and on average they stay for 18 months with me. So that's my model. So I know that I make money at month 18, but I need a lot of capital to get them at $50 a pop, and therefore a lot of capital can be deployed, but you have already established that it's a profitable business, just needs more upfront capital. So that's kind of a £3 million. There is absolutely no rule, and everybody defines what it is. So Series A, instead of an amount, Series A is typically a stage where you're at that stage where you have found your customers, you know how to get them, you know, which social or digital channel you can use, and you know the return on that investment, but you just, at the moment, you're just living off your profit at the end, which you put back in the beginning and get a few more customers, and that's a very slow growth. Whereas with capital, you can really grow. So Series A is more about this. A lot of companies think that it's either an amount, or people think that it's due to the significance of the round, and it's not. It's just a stage of your company growth.
Great, thanks, Francois. I'm scrolling down to the next question, which is from Daisy. So Daisy is wondering how you prioritize feedback on your pitch decks. So lots of companies go out and send their decks out, and they get lots of different types of feedback. And so how do you prioritize that feedback? And do you need to change the way you present your pitch each time, or do you need to have one pitch that's really your sort of gold standard? And Daisy, feel free to jump in if you want to add on to that.
I can answer that. So filtering pitch decks is going to depend on who you're talking to. As always, you know, define your audience, and then if they are, I don't know what you do, but if you're a SaaS company, you're going to chase SaaS investors, early stage or A round. You're going to have a story that has the markers of a SaaS company with strong growth potential for SaaS investors. So I normally have only one pitch deck, you know, 12 to 15. I have an executive summary, which is the mental hook to the brain. I have a deck, which is, all of this is a subset of your full fat deck. I have a deck that I use I normally print it so that people don't look at me and the background, but they look at me in the eye, and then I leave them a piece of paper that I printed with whatever information they're asked, which is a good indicator of what excites them or or interests them. So you have a big fat document, and then you extract the bits that they want. You're not going to be able to have every single variant of pitch text for everyone.
Yeah, that's great. Thank you, Francois.
Right.
I was one of the co-founders of Mortgage Mates, and so reviewing your feedback and then looking at, I guess, talking about VC funding, that definitely wouldn't be the location that we're currently at, but understanding your feedback and how we proportion that into the pitch deck as we stand at the moment, and just comparing that with other feedback, and then making sure we have the best version of a deck that we can have for the level of funding that we will be seeking in the near future. So
yeah. So I remember very well. Very happy to do one-on-ones, by the way, guys. This is what we do. We do this day in, day out, and we're here to help. It's very easy to bash something and say, oh, that's missing, that's missing. That's the first, that's the first line that I always say, look, you need to think about those missing components in your pitch. But after that, happy to help, of course. So do call and do send things. There's plenty in your industry, mortgage brokering, all of the fintech industry has moved into making raising a fund or loan or a mortgage way easier. So there's plenty of companies that you can learn from, for sure. For sure.
Thank you.
Users. I got a question here from Joshua. Marcella has picked a few questions. Joshua is asking, to get funding for a product that requires around $50 million for development and 3 years to complete development, who are the best investors to target and the best method to target those investors? So it sounds like it's a pre-product, pre-everything, and you're trying to raise funds, a significant amount of capital for funds. So those kind of pre-product, pre-revenue, pre-product market fit investments are very rare, and typically you're not going to get them in Europe. It's extremely difficult. The only exception to that rule is if it's something that is strategic to a government or to the European Union. So think of space, or think of agriculture, food, because that's a big thing coming our way, shortages everywhere. Or something that is defense, military, something that the EU government will want to invest, whatever the risk of the low return on capital, because it's a strategic investment. So I would look at strategic investment funds. Europe has one called the EIF, the European Investment Fund, which is a fund that invests in VC funds, most of UK included. Most VC funds today, including the UK, I think it's 62%, have been anchored. So the first funds have been set up with European money. I would look there. Otherwise, I would look at the US. Again, depending on your industry, pre-product, pre-customer, pre-traction, super difficult to raise large amounts because it's literally a story that you tell them, and there's very little else to show. Americans are happy to throw money into high-risk sectors. Europeans typically want to see a bit more meat around the bone.
So if I can just add to that, so we're not exactly customers. So say we've got contracts, so an offtake agreement that says if we produce it, they will purchase it, but our product is going to take 3 years to develop it. Like that's just the time it'll take to make the product. Does that provide a bit more clarity as to the potential investors potentially in the UK or Europe?
Yeah, for sure. And it's very helpful because if you have already, so you have product design and you have a customer, and then obviously the product takes time and finance to build, then they are, which is the good news for you, you have ways to finance this, which is not venture capital. Especially in space, as I mentioned, I didn't know it was you, so it's been a perfect hook. I wasn't too far off. There are funding sources that don't require equity, but they will be doing either revenue-based shares, which is the hot thing right now. No equity, no dilution. They don't sit on the board, but they preempt what you're going to do with the money, and then they take a revenue share at the back once you start producing revenue. And there's also strategic funds that will be given OPEX capital. So capital for the sole purpose, not of building a team, building marketing expenditures, but literally building the product that has been sold. And these are non-traditional sources of capital. But I think in your case, that might be a really good set of investors to go after.
Thanks for that.
I've got another question from David, which is, when in between startup and scale-up phase, how are companies typically valued? Is it based more on existing revenue and a multiplier of revenue, or projected revenue, or blue sky potential? And do you have a process or metrics that you typically use to create that valuation? That's a question that comes very often. It's a good question because it's so much hype, and the press is very good at talking about the billion-dollar, multi-billion-dollar, but actually the reality of this is, it's completely not the truth. So what in the early stages, when you're still not at that Series A stage properly, where you have defined where your customers are, you know how much it costs you to get them, how much revenue they produce, how much margin you generate, you just need to get more fuel to grow quicker. That's Series A. If you're before that, in that zombie, gray zone, what you typically want to do is to secure your runway. I explained that the biggest driver for you at that stage is not your valuation. It's to have the capital to ensure that after you've raised the money, you have a significant valuation increase in your next round. Otherwise, these investors are going to dilute. And that's the fear of most investors in the early stages. They do not want to take a risk and have a company that has not progressed massively, therefore has a massive increase in valuation on the next round, because if the valuation is pretty much the same as today, they're going to dilute massively. And that is the fear number one of investors. So you want to have long enough runway, typically 18 months with all your costs covered, because in 18 months, you'll have a chance after you got the funding round to build your team, make some mistakes, fix them, and start growing nicely, so that your next round will be based on a nice growth trajectory with 3x, 4x, 10x the valuation that you're selling now. So don't focus too much on the valuation today. Focus on having enough capital and enough time to have a massive valuation on the next round. Investors want to see 3x typically round to round. Now, in terms of calculating the valuation of today, what you typically do is, I need 18 months. What's your burn rate today? What's the burn rate after funding? I need, the team needs to be bigger. I need a marketing person. I need a salesperson. I need a lead generation, whatever you need, engineers. So get the full cost. Make sure that you multiply this by 18 months so that you have your cost of operation, your office, your fixed cost taken care of, and how much of the company you're ready to give. It's that simple. I need 5 million divided by 20% maximum. That's my valuation. It's remarkably simpler. And if you think like this, you're going to see that within 5%, you're going to see all the rounds landing around the same numbers. It's how much you want to raise, so that how long you have to get to the next round, and how much of the company you're happy to negotiate. Any round of funding will cost you between 15% and 25%. In the very early stages where there's a super high risk, investors want more. In the later stages where there's less risk because you have proven stuff, you get away with 10%. But typically count on a 15% dilution for a round of funding. And that's roughly what you're going to have. So 5 million divided by 1/15% is your pre-money valuation, plus the 5 million, that's your post-valuation. I've got a question from Dylan popping up. How do we get support along this process that we can trust, but we can also afford? Super good question. I think this is, and I've been in there for close to 30 years now. There is something that the governments should do, invest in, and hire a team of professional investment bankers, professional guys like me who've been through the trenches. I'm not smarter than anyone. It's just that I've made every mistake in the book. So therefore, I'm now giving you very simple stuff because I don't want people to make the same mistakes. There's plenty of me's, I'm sure, but we're expensive. And therefore, I believe it's something that as part of generating an ecosystem, governments around the world should be investing in optimizing entrepreneurs' valuations, optimizing their processes, helping them with lists of building the pyramids of priorities, all that stuff. You're not going to find this anywhere. So you normally get what you pay for. You have some outstanding boutiques, specialists, they will cost you an arm and a leg. You're going to get some cheapy young kids who claim to be amazing, but actually they've never invested, they've never lost money, they've never failed, and therefore, their advice might be jaded or biased, and you're going to have to figure it out for yourself. Obviously, I would claim that, I'm the perfect middle, and everybody else will claim that they are the perfect tool. Depending on how much money you raise, you will have different categories of people ready to help you. If you raise very large rounds, you're going to be able to go to investment banks, but investment banks have a tendency to introduce you to the same investors, the same banks, the same people that they have done another 20 deals before. So you're in fact throttling your overall scope. And that's what I don't like with classic investment banks, is they make it sound like they can connect you with all investors globally, and then you end up with the same 20 guys that they do deals with all the time. And therefore, those guys will determine your valuation that maybe in the US or in another country would have been way better for you. That's the downside. If you go for individuals, be very careful that these individuals, despite their claims, actually have lists of fully qualified, fresh data that they can put you in front of. Because it's one thing having all the great advice in the brains, but if you can't actually execute on the process, it's not really going to help you, Dylan. So it's going to be that fine thing. I don't know where you're based, Dylan. I think you're going to find Europe is way more advanced and structured, simply because there's more capital and it's a super fast, super competitive environment. So there's plenty of companies. We focus on doing a particular type of company that we think really works, and we provide all of the tools into this kind of 4-day program for that reason. Because once you leave, you have so much to do. There's always problems, and therefore, if you don't focus on your own funding, you don't prepare well, you're not going to have the documents, you're going to go add to market, half-baked, half-prepared, and you're going to get slaughtered. And that's what I see all the time. 90% of deals fail for that reason. Lack of preparation. Well, one, you're not made for VC, so nobody will invest. Or two, you come out unprepared, and then right at the end, when you have five investors now jumping at you and wanting all the data, the data room, all the documents, you just fail, and therefore they just give up. That's my view. Daisy, question. If, as a company, we're not looking at securing VC funding, is it still beneficial to pitch on Thursday? I think it is. Well, it depends how prepared you feel. If you feel highly unprepared, then I would say come and seek advice. Because remember, a pitching round is not a pitch where you have a script and you deliver your thing actor style. The idea is that you want to come in very much like how you described it now, to say, I want to figure out where I am or where the position is, what I should say but I'm not saying, what is it that's missing, what is it that's good and I should keep. In Mortgage Maze, I love a massive piece, which is you're defining a new category that has been already defined, except that nobody does that for mortgages. So everybody's sharing everything from bike to deliveries to pretty much everything now is not being bought, purchased, and owned, it's shared. And so sharing mortgages and the workload and the complexity of a first apartment or a first asset is bang on trend. So that, I think, is a big one. Now, it might be that you're not explaining clearly the rest, and I think coming on Thursday would be very valuable just for that, because you're going to get feedback about how you could maybe simplify or crystallize, which is what we do all the time in our program. Make things simple. Talk to your neighbor, your grandma, somebody who's not from the industry, and explain what this is an amazing business. That, I think, will be the value that you're going to get. And that you can use in a pitch or in a commercial pitch or anything. But having something short, sharp, and really crystallized, I think is very valuable and worth you coming.
Yeah, wonderful. Thank you.
Dylan again. What about angel investors and those you recommend in your earlier slide versus VC? Are there major differences in the advice? So no, thankfully, your preparation, the set of documents that you need before you go out to market, the pace and the crystallizing what makes your company really special or better, faster, cheaper, whatever the arguments are, is going to be exactly the same. It's where we spend most of our time in the bootcamp, is to dig through all the noise, the tech jargon and stuff, to say, what is it that makes your service or your product that special, or an outlier, goes against when everybody's moving right, you're the one going left. that once you have that, it's very easy to deliver a very simple, short message. The audience will be exactly the same. They're going to expect and they're going to want to do two things immediately. One is, do I like that person? Do I want to spend 10 years, because an overnight success is 10 to 15 years, remember? Do I want to spend 10 years with that person through hell? Do I want to get married? And number two, is it something that's exciting? The difference between a VC fund and a private investor or an entrepreneur, becoming a family office, is that they have much more knowledge about particular industries, typically, because they've been in it, they've failed and then rebuilt and then have an amazing contact network. And number two, they want to be able to talk about it over at dinner. And that's why at the moment you have a huge amount of impact investors and tons of investment for social and society's good, because it's cool and it's something that makes them feel good and they can discuss that at the dinner table. Whereas another CRM platform for mobile, less exciting. So pitch is the same, preparation is the same, the questions will be the same, and your hook to the brain has to be exactly the same, irrespective of investor type. We've covered now questions, so anybody has anything else? Any questions at all?
I think I'll come in and just reiterate what Francois has been saying about the pitches and the pitch session on Thursday. We've really assembled a great team of people to give you that feedback and to engage with your ideas and your thinking. So for those of you that are ready, go ahead and do your sort of 3-minute pitch and really treat this as an opportunity to have a practice run in front of some people who will give you fantastic feedback and advice and will be interested in making sure you're successful. And for those of you that feel you're not quite ready to do the full 3-minute pitch yet, come in with your ideas and bounce them off the panel and really think about using their expertise and their experience and the time that they've got for you to build that pitch up. So we're all here. Francois is really very kind, even when he sounds scary. We're all here to make sure that you are as successful as possible. We're not here to terrify you or make you feel like it's too hard or it's too early. We want to make sure that this 3-day program makes sure that you are as successful as possible once you're ready to expand and bring people on board. And we've had a question from Chris about confirming the people on the panel. And yes, I have those names now. So those people will be uploaded onto the Tame platform today, and I can confirm those names and their details to you in the email that will come out for you this evening with a wrap up of today's program as well. And that will also include Francois's big presentation, which we raced through today, so that you can sit back and sort of go through the VC dictionary and understand what it is they really mean when they say no, or what it is they mean when they're talking about the various technical terms. So I really think that having those resources and thinking about those resources as you start to prepare for funding at any level will be incredibly helpful. And the best funding advice I ever got from a friend who had a startup which got very well funded but had some difficulties at exit stage was, don't seek funding from your ex-husband, even if he's really rich.
That's a very good one. I always think as if you're investing, it's even better, because then they feel like, oh, they're being indirectly grilled. Very good call. Very good call. Well, I've got a question from Dylan here before we close.
Yeah.
Question about being polite. How do you get all that information without seeming like you're grilling them during those short phone calls? If you take your time a bit to do this, will they lose patience? So again, different people have got different speed, Dylan. Generally speaking, investors never get asked those questions. So you will be already remarkably different and interesting by you having a basic understanding of what a VC fund needs to do. 10 years, 5 years investment, nurturing and selling and all of that. Learn the lingo. If you're interested in their business, they're going to spend way more time with you. Therefore, it's not going to feel like, oh, you've got 30 seconds. So definitely engage as if you were investing, or your wife or your partner was investing. That's a very good call. And number two, take your time to define what you want the most. Some people just think that they need capital and realize, actually, no, having capital from a monster is the worst decision I can make right now, because I'm not ready. The company is not fully set up. We've got a lot of stuff to discover. So I need to have an investor that actually understands that, and also might possibly introduce me or help me with people who can help me define my product market fit better. Some people are, some people are not. Some people will immediately jump on numbers and not care about anything else. Is it the right person for you? It's for you to decide. Those questions, so don't be too polite, and I think you're perfectly fine to ask, to spend 20 to 30 minutes asking questions, and then have 20, 30 minutes for the investor to ask those questions. Remember, I showed you, please download the PDF. You'll see the questions that you're going to get on your first qualifying phone call are pretty similar all the time. So make sure you have short, sharp, and confident answers to those questions, and you'll sail through them in 20 minutes. And then in reverse, I don't want to introduce to say, by the way, it's really about us figuring out, whether it's a good match. Do you mind if I have a few questions about the fund? I'm very interested. And then you say something polite about, oh, I have seen on TechCrunch that you've just raised that much. Is it really that much money that you have? And you engage as if you were genuinely interested. And you should be genuinely interested anyway.
That's great advice from Francois. It's always important to remember that people love talking about themselves. So the more you're able to ask them about themselves, the more they will feel like they're being included, and you're really building that relationship, which is the key to a successful funding round. Do we have any final questions? Otherwise, I think we can wrap up for the morning. It's been a fantastic couple of sessions. I know it's a huge amount of information for you all to take in. Tomorrow, we'll really be focusing on how to engage with potential enterprise customers and to think about whether or not partnerships are right for you. So for the company that's thinking about the joint venture, I think this will be a fantastic session. And then the second session tomorrow will be about PR. And as someone who has a background in corporate communications, I always think that PR is central to anybody's launch. It's really important for you to be able to define your brand and your story. What Francois was talking about today, thinking about how you tell that story through your slides and your fundraising and your pitch, that's effectively PR. So it's really important that you think about how you talk about yourselves, how you present yourselves. It was fantastic from Erwin to have that interjection this morning about how you're already thinking about characterizing yourselves in the market and how you talk about your company. So we're really looking forward. We'll be online again from 8:45 tomorrow morning with a wrap up of today's sessions. I'll be in touch later today with the Zoom links for tomorrow, with any of the documentation, and also please do send through any further decks that you want feedback from Francois, and he'll do those. Otherwise, we'll see you at 8:45 UK time tomorrow morning.